are going to ask ourselves, Kenyans are smart people. They're in international firms, Fortune 500, and if you have those smart people, some might argue is that there was no additional capital or anything like that. But are we really being honest? So we are going to ask the tough questions, and I am really, really happy that our speakers decided to join us. My name is Irene Gadiaka. I'm your host this evening. I really do appreciate the fact that you made the time, and I'm also hoping that you have tough questions for our speakers, and for Tom Itoho, who is, he's trying to hide here, but he's, he's covering his face. But Tom Itoho is the CEO of Britain, and there are questions for him on what your strategy is for SMEs, and a few others below that. So there will be questions for you as well. And I'm imagining that everyone here has a question or two for the speakers. So we are looking to start. Ours is to look for, can we go past that hurdle where failing in startups is so common that it almost becomes a stereotype? Because what we are doing is, if we don't change, we are messing it up for the people coming behind us, especially when it comes to financing. Because everyone will be looking to Kenya and say, so many of them start, but how many make it the distance? How many even go past the 7-year mark? How many don't keep you sleepless at night if you're an investor? There have been so many of those. So let's get candid. Let's ask the tough questions. Nairobi Business Forum does a lot of this, as you know. And today, it's no different really. If you remember, we had a few sessions, including the Michael Joseph one, where we partnered with APA Insurance. And we are doing the same again today because I feel they understand what it is that we're trying to build. And the reason I started the Business Forum is we need to stop looking at others to create jobs for us. We have to be the job creators. So all of these people here that we get to speak to us, the experts, Tom, Catherine, it's an idea to tell you that once you're educated, you're a mover and a shaker from that point on, because what you have is the know-how. So join all those dots together in a way that you don't start saying there are no jobs. How about looking at it as, let's create jobs, and if we all team up together, I'm sure we can come up with something nice. I see you there. He's creating a Facebook similar type. Yeah?
So it's more like a WeChat for Africa.
Oh, WeChat for Africa, there you go. And it's already taken off. And you see, when people start doing things like that, then he'll absorb some people in the employment space and educate them. And so the conversation starts to be, what else can we create in this market? I'm going to ask Catherine of APA Insurance to tell us why you partner with us and what it is that makes you feel that we can go the distance, and especially what you offer in the small business space in just 2-3 minutes. Why APA is so passionate about the SME space.
Briefly, as she has mentioned, APA is quite passionate about business and protecting businesses, because when we talk about why businesses fail, and especially SMEs, we cannot fail to talk about the role insurance plays in minimizing that risk of failure. Because some of the reasons why businesses fail are risks that can be mitigated through insurance. We know businesses face a number of challenges. Talk about, you put up your business, sometimes burglary happens, fire happens, and other unforeseen disasters and events. and those have a lot of financial implication to the business because those challenges store the business operations, and that impacts on the finances. But insurance, when the insurance comes into play under the protection piece of the insurance, then it is possible when such claims are paid for businesses to actually recover, come back into operation as fast as possible, and therefore it means that business which would have completely gone down has been revived, and the continuity of that business is there. In case of death or total disability, it is 8 times of annual salary, 96 months of salary. That can actually have a big impact on the finances of the businesses. But we have solutions that speak into that businesses can buy WIBA policy, pay a premium, and in case something like that happens, then insurance is there to stand with you, and therefore you can continue with your normal operations without so much worrying what if something happens to my employees while they are working. That gives you a peace of mind. So it also comes in to cover businesses from such regulatory requirements that would have implications. And you can imagine if you don't meet it, there are also fines and penalties that come in besides paying the claim that would have a financial implication and therefore increase the risk of business continuity. There are others which not only they are not pegged on legal and regulatory, but they are good to have. For example, the health insurance for staff. Yeah, we say that is kind of a motivation for staff, because if you have staff and you have some medical cover for them, then it means they can work without so much worry. The level of motivation, staff welfare is increased. So insurance somehow responds to that. And also businesses that take insurance, I believe from lenders' perspective, they are considered more creditworthy, in my perspective. Because if maybe you are getting credit and the lender knows that you have all these protections, I believe it increases the creditworthiness of the business, and so you can access credit better. Besides all these packaged products or solutions that we have, we at APA we also customize. Yeah, we pride ourselves for being trailblazers. So we customize, we listen to the needs of our clients, of our businesses, and we can customize package solutions that speak to your specific needs. I'll talk about one of, it may not be specific to APA, but I think it's something that is not talked about, that speaks into small businesses and SMEs, which is the Keyman insurance. I don't know how many have heard about Keyman insurance. Yes, it's more or less, it's basically a life cover, but it speaks into the specific need of an SME, because it has, it responds to the needs of an SME in 3 fronts. One, when you're an SME, maybe you're taking a business loan, the business loan is paid on the owner, isn't it? What if something happens to that owner and it's a business loan? The business will be left to struggle and pay. But this Keyman insurance protects that key owner such that that business loan can be repaid in case a death or total and permanent disability happens to the business owner. It can also respond to partnership protection. We are businesses that have partners. Yeah, I'm just concluding. If something happens to one partner, there are questions that come around there. Yeah, do we bring the family of the deceased partner to come in, Or do we buy the partnership? Or so that's the response now into that partnership protection, and also into the key man protection. There are key people in small businesses such that if they are not there, even the profitability or the top line will not come in. So knowing that there is such a key person, this cover can respond to that, which gives protection in terms of the level of contribution that key person makes to that business. So in a nutshell, I was giving an example of one of the customized that responds specific to the SMEs. But that doesn't stop us from engaging and looking for other ways that we can come into this space and help you thrive as a business. Thank you very much.
Before you go, if somebody wants to talk to you a little further and explore, tailoring something for their business, how do they reach you?
We have our contacts details. We have a very active contact center, which you can call anytime. It's 24/7. We can respond to you. So you can reach us through the contact center. You can even do a query even through our websites that goes straight to our contact center, and we're able to pick up that. Even through the social media, we have an omni-channel system that is able to pick all the correspondences from our clients from any channel of communication. And you can call our company line and ask for me. Yes.
That we are creating a pattern here and it's not good for Kenya. So, I'll start with you, George. You'll tell us a little bit about the bird's eye view in your space, especially what you picked up in your career. And the reason I'm not doing traditional introduction is because we read about the bios. I sent that out to everybody. But I also feel that they'll tell us what it is, that even though they are successful, there are some issues in the Kenyan space that eyed them. So, George, thank you so much for making the time. And you've heard those numbers. Are Kenyans honest? Are we actually starting businesses that say, I intend to do the right things, or am I just setting up a shell, aiming to get the grant money, and then I don't care about the investors at all?
Very hard-hitting question, Irene. And so I'll start by thanking everybody for coming today. And just to state that it's an honor to speak to you. I'm not here to share any expertise, but really just to share my experience. It's nice to see and meet Fanny again. Fanny is one of our investee companies. Yeah. So we've invested in MFS. So we will speak about that, and she'll speak to it.
And you talk about the name change, because
yes.
I can't keep up.
Yes. My name is George Odo. I'm with African Invest. African Invest has been around for about 30 years now in the private equity venture capital space. Started off in Tunis, 1994. Next year we celebrate our 30th anniversary. We've invested in about 210 companies in the continent. Done over 120 realizations. So, invested in over 30 African countries, Irene. Burnt our fingers a few times. So it's not been a rosy story all through and through. So it gives us a bit of credibility to be able to speak about what has worked and what hasn't. And I'm happy to see some of our business partners in this room. Actually, Shah is here. He's running a very successful business in the packaging space, a regional one. Tommy Togo, as you mentioned, also business partner, 7 countries, more than 2.5 million clients, very successful insurance and financial services group. I see other familiar faces, so nice to be here. And yeah, the question you asked about, bird's eye view, what do we see? Are Kenyan entrepreneurs honest? We talk about 8 companies that have failed. The reality is, those are the only ones that we know of. Those are sort of the high-profile companies. The failure rate is a lot higher. They say that 9 out of 10 startups fail. Those are the statistics we have. In the US, that number is probably a little better. It's maybe a little better, but it's the same story everywhere. And they say that 7 out of 10 of the ones that get to the 5th year. So you get your 5th year, we think it's okay to breathe easy, 7 out of 10 will still fail. So it gets more dire as you go on. What is going wrong? Is it a Kenya-centric problem? Probably not. But are there some nuances that are unique to Kenya? Maybe, and we can get into the details. We see a lot of issues. We've invested in startups. Very often, a lot of startups, one of the big problems they have is not hiring right, Irene. And not hiring right, what we mean is, George may be the entrepreneur, I may start a business. I need to start to separate myself from the business at some point. I need to make sure that I have a bench, I have people who can take over that business. And it's a psychological thing, because you're actually admitting that somebody else can do this better than you. You've taken the business to one level, somebody else is going to take it to the next level. Just coming up to that admission is a big deal. But when you get there, that's a sign of success. So a lot of startups and businesses struggle passing on that baton, to the next generation. That's an important one. The next generation does not mean your family. It means the next manager. So that's one thing we see. Very often, businesses also focus on, there's a fad. You start raising money. You find that entrepreneurs are focusing on raising money instead of doing business. So you're raising grant money, you're raising Series A, Series B, Series B plus. You're always on the road, on roadshows raising money instead of focusing on running a business. And why is that? It happens very often because people are not keeping their eyes on the basics, the cash flows, the profitability, the expenditure rate, the expense rate. That's important. Those basics are important. And very often we find ourselves saying, LinkedIn is not profitable, Facebook wasn't profitable, and we compare ourselves to some of the big giants from Silicon Valley. But just getting back to the basics is very important. So we see a lot of startups failing, Irene, because of those basic problems. Management, profits, those basic problems. And then, very important, are you solving a real problem? Or are you just coming up with a business that you like, that looks good, sounds good? WeChat, for Africa. What's the problem? What is the underlying issue you're addressing? If it's there, if it makes sense, then you will succeed. If you just rolling out a model because you like it, it looks good, it works, you're not likely to be able to scale it up, and it will struggle. So, you could come up with a laundry list, the 10 reasons why startups fail, etc. But what we are seeing uniquely in Kenya is we're seeing a lot of entrepreneurs coming into the market, and these entrepreneurs are focusing on fundraising instead of focusing on running their businesses. We're finding that there is no generational passing of the baton. We're finding people, again, the issue is, I have to emphasize this, if you're not focusing on profitability, you're always focusing on raising money. It's about run rates, it's about burn rates, and nobody's looking at your profitability. And even if you're not profitable today, you must have sight to profitability. And very often businesses are not doing that. You have to be bankable at the end.
And we'll come back to that because I feel you're going to share the microphone. Franny, you just mentioned something about scalability. And given the space that you're in, you're going to tell us, your full name and why you changed the company name and where the geographies that you're in. But I'm also thinking, you've been around now for how many years? 5, yeah. So well enough to kind of assess the space. Scalability for me is, it looks like people are raising money without a clear idea of whether they're scaling or whether they're just burning. Yeah, so from where you stand, from your vantage point, how has that been with the businesses that you're dealing with?
Absolutely. First, just want to say thank you to Irene for bringing us all here tonight. It's a really important conversation, and I'm here to learn from all of you. It's an honor to be sitting here with George. So the sort of tidbit of background, my name is Franny Tyner, originally from the States. I've been in East Africa for about 5 years. I'm currently the Director of Corporate Development at Onafrique, formerly known as MFS Africa. We are one of the largest payment networks on the African continent, currently working in over 40 countries on the continent and about 70 countries globally. So a footprint that we're really proud of. I want to start by echoing a point that George made. Failure in the startup space is normal. It's something we see across the world. The stats that George quoted, 90% of startups, plus or minus, fail. And so I think what we're seeing here is a normalization. I think we're seeing a market start to come to maturity. We're seeing a number of venture-backed businesses sort of reaching that point where they weren't able to find product market fit. And that's fine. I think there are a number of problems that those companies failed to address properly, and a number of challenges that the African ecosystem presents, as well as the Kenyan ecosystem in particular. And I'm looking forward to discussing those tonight. But to answer your question about scalability, it's everything. No single market in Africa is big enough if you want to build a large business. And one thing we've really focused on is Onafrique. So we were founded in 2009. From sort of the second or third year of our existence, we were operating in multiple markets. Each individual market poses a massive risk, be it regulatory, be it currency, be it just size of the market. And one thing that we strongly believe as a business is that you have to be operating in multiple geographies in order to grow and scale to be a meaningful size.
George, I'll ask you, that's a lot of money that has already been lost. Are we raising the right kind of capital then? Is it too expensive? Is the tenure matching with the kind of business that we hope to do? Where are we going wrong in the sense that, because I want to believe that majority of the people that start startups are not starting to fail. Yeah? So then the question becomes, how do we tick all these boxes the right way? Not just that I raised money or I'm doing these road shows, but I actually matched my kind of business with the right capital. Do we do that in Kenya?
Again, spot on question, Irene. I recall 5-6 years ago, I used to regularly teach at business school, an MBA class, and one of the modules I was teaching was actually international financial markets, your need with the appropriate funding. Most entrepreneurs do not go out for the right type of funding. And you go and you think about it. In fact, don't even make it complicated. Most of the people in this room have probably started a business. When you start a business, how do you fund it? If you're salaried, you take your salary, you pay for part of it, you might use your credit card to pay for some expenses, you might get some money from family members, and you might tell your sister, I'll pay you back next month, even though you know you'll not be able to pay her back next month.
That's so true.
So the point I'm making is you actually get money, the money is accessible, but it may not be the appropriate kind of money. You're funding long-term needs, your capital expenditure, your capex, with short-term money. So that's a problem. So there's a mismatch here. So very often that happens. And again, if you get complicated, you jump to the international financial markets, you find that, do you need venture capital? Do you need venture debt? Do you need private equity? Do you need mezzanine? Do you need vanilla debt from a bank? And even if you go to the bank, are you taking senior loan? Are you taking a working capital facility? There's so many different types of money. So the first thing you've got to ask yourself is, what type of money do I need? And very often, we make the decision ourselves. There is value, I'll tell you guys, if you take nothing away today, there is value in having a good advisor.
The problem with us Kenyans is, as George says, that somebody has started a bar, is doing well, so I go next door and start a bar. Somebody wants to, and what we do is we always follow. Me too. And the problem, I think, going back to startups and the issues that we have with startups, you look at Sandy. Sandy was doing excellent. I think it was a very good idea and people were using it. Then Sky Gardens. Sky Garden, they started this basically a marketplace where you could own a shop within their establishment. But again, I think the problem that we have with startups is that when you first start, when you start the business, you've got good ideas, you have got potentials, but then what happens is that where do you go wrong? You start hiring wrong people. And once you hire wrong people, the CFO, I'm the group CEO. But what are my qualifications to be the group CEO? I might be might not have any qualifications. The only reason is that I can go and sell myself. And when I sell myself, somebody out there thinks that I am the best thing since sliced bread, and then I'm hired to run an organization. So I think most things, I think, for startups, successful startups are here. I know George has backed a lot of startups. Tom rang me up one day and he talked about a startup that he has, he's with, and they're doing quite well. They're in short tech, so they're doing quite well. So I think what happens is that what we seriously should be looking at is what the right element to help grow that startup. If you look at Sky Garden, we have a group of people, we have a group of friends. So we look at different startups, and we invest in them, and we say, okay, we'll pull $100,000 or so, put in there. So Sky Gardens was a disaster. It was the guys who were running it were actually, taking top dollars for working there. In startups, Akshay can tell us, he's in a startup called Ponea. So how much does he take there? I think he hardly takes any money. He takes zero, but he puts in a lot of time. So this is where it is that I basically believe that what we need to do is startups must be taught that, okay, it is going to be hard work. It's going to be like starting a new job and trying to create a life, so that whatever you get from your earnings, you have to see how to save it to buy the first car. Kenyans always end up, all the people that we have employed, 30 years old, first thing they do is buy a car. That's the first asset. And I tell them, why don't you look for a house? Because there are now houses being advertised for 2.9 million shillings, etc. So when we have a mortgage facility, why don't you go and do that? No, first is a car. And that's how we do it. So perhaps what it is that we have to really understand how do we run our own personal finances, how do we create our assets, and the same way, if you go into a business, how do you run, how do you do it? Because in the early days, you can't take anything out of the business. You have to put in a lot of hard work, you have to put in all your savings, and you have to go to your father, mother, brothers, and ask them to put their savings in there as well to help you grow that startup. But then there have been certain successful ones, and those are the ones that we should learn from.
A lot of startups, when they get into the market, they raise a lot of money. And once they've raised money, then they go and hire globally. And they hire the best managers sometimes, maybe not even the best, but certainly the best paid. And they bring them locally. And that starts to eat into the money raised. And very quickly they start raising more money because they realize they cannot continue paying these guys. there was a startup. It's actually one of the most successful ones. In fact, people are still calling them a startup. They're now EBITDA positive. They're one of Safaricom's biggest partners, one of the biggest employers in this market. They've got multiple products. They've done very well. But I remember in the early days, what they used to do is they used to, the entire senior team were expatriates. Then they realized that that was their biggest cost structure. So they quickly realized that we're employing expatriates, some of them great schooling from Ivy League schools, but no experience, certainly no local experience. So they quickly made the switch over. They mixed their management team, then they went local, and they've taken off. So they solved that problem. They got a couple of investors, international investors came in, backed them. But hiring poorly is one of the issues that startups have. Yes, actually. Don't guess who I'm talking about.
Part of the problem where some of these startups end up hiring expensive Ivy League graduates and raise more money than they need is because of the venture capital funds. They are pushing down all of those conditions, and rather than looking at experience on the ground, they're looking for a piece of paper from Harvard.
Yes.
So, how is that problem going to be solved for Kenya?
Your name, please?
I'm Akshay Shah.
Well, now it starts to get interesting. It starts to get interesting because that's exactly what I was looking for. Kenya-centric problems. And there really is no need to go all out for an expatriate team. I would say don't go for any, but you can mix it up. And the reason we need that is because of the local experience. And then I'll come to you from here and ask, alongside that, if you're starting a startup, you have to pay attention to the partners you're bringing on board. Because some have failed not for lack of money or expertise, it's conflict. How do you do that right? You need partners, no one can do it alone, but selection of partners, whether you're choosing, some choose even family, people they have worked with, but what exactly should we be considering?
Yeah. First and foremost, it's about incentive alignment. You can have a beautiful contract, an idea. You can have a beautiful idea of a partnership that you'd like to execute on, but if there isn't something in it for both parties, it doesn't get off the ground. Something we've done in a few scenarios is invested in local partners. So we provided equity capital to businesses that are operating in markets that we want to be in as a way of incentivizing ourselves to maximize their interest and also them to maximize our interest. And it's not without its challenges, but that's been a great way for us to, one, solve the issue around incentive alignment, but two, to come back to the point that was raised earlier about the importance of having local talent. It's the expatriate thing I completely agree with, and I'm saying that as an expatriate, although I didn't go to an Ivy League school. But it also applies to, I have a friend that runs a business here in Kenya, and they took their Kenyan team over to Uganda to lead the expansion, and it flopped. But then they reevaluated and hired in a few Ugandan talent, and they were able to get it off the ground. So it's this local knowledge that's so important in each market where you operate.
Do you want to say something on partnership?
Yeah, partnership is critical, and for me, partnership goes beyond, who you're doing business with. So partners around the table. It's partners who you can work with, other than in-house resources, so partner organizations, and that becomes important. But also your business partners. So if you're thinking of investors. We have seen investors bring down businesses. We have seen, so getting the wrong type of investors can cripple you as well. So right partners at every level matters. And you've got to incentivize those partners. If you're hiring, we talk about hiring the right team, make sure that you're compensating them right. And sometimes it's not even about the money.
Yeah.
They've got to have skin in the game. if they're the right people, then so incentivize the team right, let them feel the ownership, whether it's through an ESOP, whether it's through a phantom scheme.
Yeah.
So sometimes we have to look out for, and again I talked about integrity, so sometimes we have to look out for those sort of situations. We managed to solve this situation and we, got the route sorted out and we're back on track and we managed to get out of that situation. Sometimes it's not always the case. So the time we invested in Libya, the Libya one, we invested 2 weeks later, Arab Spring started in Tunisia. After Arab Spring, the rest of the Arab world went haywire. What bailed us out there is we had an insurance, a meager insurance against political risk, and that helped us out. So if you're thinking of all these things, think about management team, think about appropriate type of money. You think about in management team, you talk about hiring properly, you talk about partnerships. Also thinking about insurance. All of these things you must think about when you're going into a business because this is what can make the difference.
Expanding too fast. I'll start with you. I don't even have to say anything more, but you have seen it. Somebody opens one branch, decides it's very successful, the next expansion is for 10 of them. Yeah? We now have seen case studies that have failed. Can we just talk a little bit about the right way of expanding?
It comes down to unit economics. You have to know how your products are performing, and you have to have a clear vision of how it's happening in real time. It comes back to this point of hiring a CFO, not an accountant, and investing in those financial systems very early, because they're not going to lie to you. And having a clear sense of how things are going as you're doing product rollouts is so important. So that's
I'm sure you've seen some.
All right, thank you, Irene, and good evening, everyone. I happen to know of a group that went into South Sudan, Uganda, and Malawi at the same time. And it was awkward for the group because the lessons it was learning in South Sudan were exactly the same lessons they were learning in Uganda and in Malawi. So they didn't get an opportunity to apply some of the lessons from each of these geographies in the others. And the level of success in subsequent countries would obviously have been a lot higher and quicker, because what happens when you then spread too thin, you will obviously also get into some financing conflicts, because you might be tempted, as a famous supermarket did here, without naming names, to being tempted to obviously finance short-term or long-term financial needs with short-term money and debt. And there's also something to be said about the local nuances, even in a country. If I use the case of Britain, some of the issues we ran into in Nyeri are very different from some of the issues we ran into in Nakuru. And you could argue that this is within. So I think there's a case for taking in the experience, the lessons, and applying them, or at least adapting them well. That is what I would say. And you can't be in too many places at the same time, because some of the reasons businesses are successful is because of the management that they have. So the moment you spread your management focus, again, too thin, so it's not just a finance and money issue, it's also, the focus of your people.
Yeah.
And I find that also gets in the way. The guy who was making noise in his bike, I think it is a bike,
Yes.
could very easily be a startup.
George, I do want to say something about expansion experience. We've seen enough cases where it's gone wrong, and keeping it, Kenyan and African, then you can't exhaust it, but what's the right way to start to look at it?
Yeah, I think Tom touched on some two very critical points, and again, it's a recurring theme. Management is a big thing. Hiring right, having the right people. And Tom said it, if you're expanding, and you know what has made your success are your management team, and you start expanding aggressively without addressing that, without having the right people, that's a problem. And it's not again just hiring, it's about hiring, making sure you have the right values, right cultures, so there's an element of integration. So people is one thing, the other thing is finances. If you're growing too fast, you need money. And if you're not sensitive or aware of where that money is coming from, how much, what type of money, that becomes a problem. One of the key lessons we've learned, and again, Tom, you alluded to it, each market has its nuance. We talked about Nyeri and Nakuru. Going to South Sudan and being successful is very different from being successful in Kenya. Very different from being successful in Zambia. Very different from being successful in Tanzania, just across the border. And so each market has its own intricacies. One of the things that we found is when we went into a market where we didn't have local knowledge, we didn't have boots on the ground, we didn't have an infrastructure, we failed.
Okay.
So a big learning for us is we should never go into a market where we don't have good local knowledge or good partners. So that's an important one. So even as expanding, I think about that. Then there are macro issues, Irene. There are macro issues in every market. In Kenya, one of the things that's hurting businesses today, and God help startups because they don't have the balance sheet to take it, is the weak shilling and the dynamics around the bonds market and the debt market. So the reality is the bigger companies have the ability, they're the staying power, let's put it that way. They may not necessarily have better management, but they certainly have the balance sheet, those sort of risks that startups will not.
Okay. Frank, what's your experience in the different geographies? Just an overview. You've expanded into quite a few, and from the look of it, you seem to have done it right. What can we, like from your experience, that you would say 1, 2, 3, even if you learn nothing else about expansion, you have to consider?
There's so many different ways to answer that. First and foremost, figure out your relationships with the regulators. Don't assume that the regulatory framework that applies in one country, you can copy and paste into another. At Unafrique, one of what I think is our real competitive advantage is the fact that we don't play in a regulatory gray zone. We take regulation extremely serious, and until we have a green light, we do not move forward. And there are folks in the payments space that will move fast and break things, and they might beat us to certain deals. But our view is that regulatory compliance is so important, particularly when you're new in a market. That's the first thing. Second thing I would say would be the importance of having local team. We've said it before, you can't say enough. Having those local relationships is so important from a commercial perspective. It's how you get contracts signed. It's how you think about how to sort of iterate and innovate on commercial partnerships. It's how you get in front of the regulators. So I'd say that's the other big thing. To speak to a point that George made earlier about what's happened with the shilling, a benefit that I see from being in multiple countries early on is that you're able to hedge the currency risk. So while the shilling this year has had a tough year, there are other markets where, for example, the Ugandan shilling this year hasn't been hit quite as hard. And so, the earlier you can have revenue streams in multiple currencies, the stronger your revenues will be, and the more appealing you'll be for banks, for other commercial partners.